All right, well, an official welcome to our International Online User Group Forum for Saturday, August 8th. It's wonderful to have you with us from Canada, the US, the Europe, UK, Hong Kong, Singapore, Australia. Well, that's a little early in Australia, but I know we have some folks who got up a little bit early to watch, and that's always appreciated, and really from all around the world again today. So really great to have you with us. Dick is with us. He's an options paycheck member. Neil from Ottawa. Kamel says loves the international flavor, and I think that's something that we all do as well. So let me see if I can just show you again. This is what the International VectorVest User Group um, forum will look like here on the YouTube channel. So just to let you know about that, I just want to make sure things are advancing. Oh, there they go. There's a little bit of a lag on my YouTube, but hopefully it's going to come across. And I did push the record button, and so we're all good. If you have questions or comments, and I hope you do, we want to make this interactive during the webinar. This is our chat box, and you just type your question or comment in here. Click the send button, and then it should collapse on you to give you more screen space as we're going along in the webinar. And have another question or comment, just click on the orange arrow and that will open it up. Now I know with a large turnout again today that sound could be an issue, especially if you have open tabs, too many things going on with your computer. So if you do lose sound or audio, please log out and log back in. That would be the best way to do it. I appreciate your questions, and we'll do our best to answer as many as we can. Do keep them typing in. That would be awesome. All right, so I think everything is good on the YouTube. Looks good. All right. Just know there is risk in investing. So if you can read the top part here, but everything you will see and hear today is for educational purposes only and should never be considered investment advice. The information is designed to empower you to make your own investment decisions, and these decisions are yours and yours alone to make. So thank you for understanding that. And the purpose of our monthly forums, we want to further your knowledge of the VectorVest system, share current ideas and strategies for making money and protecting wealth, create opportunities to interact with each other and share ideas with our VectorVest community, promote meetings and activities of our VectorVest user groups, let you know that in the viewers tab there is a complete list of user groups. Now I know that regular meetings are off and we're far between now, but some are doing the Zoom meetings, so there is opportunity there. And provide a forum for VectorVest investors who do not live near a user group. Just wanted to give you a reminder, it was in the views, but VectorVest will be under maintenance or closed for maintenance beginning tonight at about 11 o'clock Eastern, and it will go on through Sunday. So I just wanted to make sure you were aware of that in case you were doing some testing and planning and strategizing for the weekend. It is going to be shut down during those hours. All right, so we'll start with our market review and then move quickly into our special presentation, Stock Selection and Selling Options, presented by Susan Hayes-Culleton, Managing Director of VectorVest Europe. And again, we are live streaming as well. And lots of good comments coming in on YouTube chat. We've got the Netherlands and more Houston, and looks like a lot of the states and provinces covered in North America. So that's pretty awesome. Great to have you with us. We always like to start with our color guard report when we're looking at the market. You know, we really are a global economy right now and global markets. So it's useful, I think, to see what's going on in the VectorVest world. And we start at the top left here with Canada, and you can see we are somewhat bullish. It's been remarkable. I know I have my Q&A webinars every Tuesday, and our regular attendees let me know that they've never seen anything like this, where the MTI has stayed so high. In Canada, we rarely get above 1.5, but we've been above 1.5 now for quite a few weeks and months, and the market just keeps wanting to go up. That's not to say we don't have our down days. As you can see by the green in the price column, we tending to get a lot more up days than down. And as we look across, it is the case in most of our countries. Singapore, a little bit of an exception here, although they've just gotten a confirmed up call recently. But Europe is in a confirmed down call, although some green lights starting to spot the color guard, so that's good on that side of it. And the buy-sell ratio back above 1, so a little bit more participation in the rally going on. And then Hong Kong is actually, if you look at, now we didn't meet in July, but if you look back in June, Hong Kong was down almost 10% year to date, and they're down now 1.36. So nice recovery there. But just keep an eye on the color guards. These are the year to date, after that February, March COVID collapse. And I think we all thought it was going to be a very rocky road. And of course, the US Fed and other governments have really put a lot of money into the economy and the markets, and it's made all the difference in the world. But it is kind of an artificial market going on right now, so we do need to be a little bit cautious, have our stops in place. But that said, color guard is green as it is in most of our countries. One caution light here in Hong Kong, one red light in Singapore. But if we're green, participate, this might be time to go a little bit small, fewer number of positions, fewer shares, tighter stops. That's called investing or trading small. And this might be a good time to do that, because we know the safest time to buy is when the MTI is much lower and even below 1. So that's kind of where we're at. All of these countries have improved over June. Most got into a DEW up signal, and firm call came a little bit later in May. So things are rocking and rolling that way. Just going to check and see if there's any questions before I move on. Okay. Neil, I have all the subscriptions given to me for when I go to present or prepare for this international forum. They're all available as an extra subscription that you can contact VectorVest about. For example, I know a lot of our US friends have also a Canadian subscription, so that they can take advantage of some of the stocks that we have up here as well. And Canadians trade in the US as well. And I think most countries do trade in the US, at least for diversification, a few shares, companies for sure. All right, so moving along, we like to look at the global markets using the ETFs. And it doesn't look like a lot of change from June, but we've got quite a few more countries in the green now. It's not all the US, but certainly the NASDAQ and Spider is leading the way again. See the gains here year to date. You can see in the date calendar, started at the end of 2019, so that I get the beginning of January going forward. And you can see the different countries here: Brazil, Greece, Turkey, still very much struggling along. Poland, our big winner from 2019, down 14%. See the others, Canada here. It's interesting that Canada is down minus 6%, even though VectorVest Composite is basically flat. So in this case, the ETF isn't performing as well. Here's what's been going on the last 15 days. So you can see triple Qs, etc., all performing quite well, and Poland making a gain here as well. Canada up almost 4% as well. So this, you can create a watch list of these symbols. When you get the recording and the slides, you can just make a watch list, type them all in, and you can track them on a regular basis. It's there's different ways. I showed you in June a way to use VectorVest to um, sort of optimize your entries and exits. And RT is the one constant here. When RT is rising, as it is here with the Qs, the triple Qs, that's a great time to enter. And then if you follow Bob Turnbull's strategy of the 2 and 5 EMA cross on a weekly graph, you're getting some very early entries, some good exits here as well. But the key is the RT. It really is setting the stage for us. Over here, you can see again RT rising. Get a crossover on UPRO 3 times leverage SPY, S&P 500, and up 42% from there. South Korea, just to show you can do it with the individual country ETFs as well. So South Korea up 31 from this crossover and the RT above 1. Peru, again, RT above 1 and the crossover. The 2 and 5 is a little faster than the 3 and 8, obviously. So it's a little more aggressive, but boy, when it's right and it's aligned with the RT, pretty powerful. All right, not seeing any questions. Just quickly, my essay for this past Friday was all about the performance graph. Bob Turnbull showed a really great use of it back in the January International Online User Group Forum. That is confirming the purchase decisions. My favorite use is really looking for divergences between bullish and bearish ETF pairs. And of course, you can find stocks that are outperforming their industry group. Maybe they're outperforming their peers, and they might be outperforming their industry group. And VectorVest has asked managing directors and myself in Canada, though I'm not a managing director, to do videos with our essays, and I'm really happy to do that. And I did a video that you're able to see on our VectorVest YouTube channel. Just to show you the efficacy of this, here's a 3-month performance graph of the gold miners and gold nuggets. And what you look for is this divergence where the bullish gold ETFs are moving up and pulling away from the bearish ETF. So you can do it with any of your pairs, biotech, any of them. And in Canada, actually, it was one of our subscribers who emailed already this morning and said he wished he had been using the performance graph with our natural gas ETFs, HND and HNU. And you can see HND to the downside here has really dominated, but HNU is starting to make a move. Percent gains from the beginning of the graph are over here at the right. So you can catch that on the YouTube channel. It's not posted as yet, but it'll be there soon. And then I did another one on silver and gold, or beyond silver and gold, how you can track some of the leading sectors. And there's been a lot more sectors than just gold and silver that have delivered some really great gains. And then I did another one video on the earnings season, how to add your earning dates to the portfolio manager step by step on that. So that's in the VectorVest YouTube channel. And here's what it looks like. You just need to know, once you go to VectorVest YouTube channel, you need to go to the videos, and there's Susan with her fantastic female Friday. She had an interview this past Friday, just yesterday, with Linda Royer, our new CEO of VectorVest. Fascinating interview. She's been with the company, the right arm of Dr. Toledo since the very beginning. That was a really great interview, and she's doing the fantastic female Friday, and this is what my videos look like here. All right, so I'm going a little fast here. Any questions, let me know. That thing's... Oh, Oh gosh, I can always count on Michael from Ottawa for a wonderful, crisp comment. Says going forward, you'll need a makeup person for your videos. They've tried different lighting, Michael. They've tried everything with that webcam. Yeah, it is what it is, to quote some famous people. Anyway, in Canada, you can see that all three of our market timing indicators ended lower over the last week, and we still have this really strong divergence with price going up. Meanwhile, the buy-sell ratio and the RT, which I don't have on the graph, both hitting lower lower lows here and lower highs. So there is a divergence, but gosh, it's on the DW Pro Trader graph. See that the 30-day weighted moving average is really holding steady. And so we have to play the rally and play what we see, not what we think should be happening. And you can see the different market timing engagement information. Canada here, the buy sell ratio had been up at 5.5 and it's down to 2.1. So number of stocks participating has certainly come down. Oh my gosh, now the comments are coming. You have a face made for radio. Oh gosh, that's pretty awesome. Oh, thanks, Bill. Appreciate your comment as well. All right. On the U.S. side, um, it was an interesting week where market timing indicators, the buy sell ratio, RT, and MTI, actually reversed and started going up, even though they hadn't fallen to anywhere near historic lows, started to move up. So the price of the VectorVest composite did struggle Thursday and had a doji. Friday, overall the week we had a pop. Quarter two earnings continue to be better than expected. And guidance says we just shouldn't get too comfortable with this market. They sometimes say downside risk outweighs the upside potential. Oh gosh. Raj, if you went to the YouTube channel, you could see the comments coming in GoToWebinar. Unfortunately, or maybe fortunately, in this case, myself and Susan are the only one that are seeing your comments as they come in. So, if you have a question, by the way, what's going on in Europe, this is a great time to chat them. And Thomas says it's good to have friends, Stans. Just wish you had some. Oh boy, you got to have thick skin. All right. I just did want to remind people of the emotional market cycle. If you Google this, you'll get 1,000 or more iterations. But the bottom line, when we marry it with our MTI historical levels, we know that the greatest risk of loss in the US is MTI up around 1.50, and we've been up there for a long time. In Canada, typically it's 1.2, 1.3 on the MTI, and we've been well above that for a long time. So we have to trade what we see to take advantage of the rally, but just don't get overconfident right now because when the market does fall, and we saw it on the Europe color guard, when it starts to go down, it goes down really quickly. So we need to be careful. The safest time to buy is at the blast off phase. Buy sell ratio is low and the MTI is below, near or below point. All right. Well, we've covered a lot of ground. Are there any other questions? I'm just going to check the comments on um, YouTube channel, and has been typing in over there, so that's awesome. Have you with us there as well. So with that, I'm going to turn it over to Susan to her presentation on stock selection, selling options. Susan is known throughout Europe as the Positive Economist. She has a website on that, and she's known for her expertise options trader and teacher as well. Authored 3 books here, currently presenting the popular series on VectorVest channel, Fantastic Female Fridays, and mentioned this Friday it was an interview with Boyer, our CEO of VectorVest, and previous Friday, it's Fantastic Female Friday. This is one that everyone should pay attention to and go back and review. It's still up, of course, VectorVest channel, because it was all about how to set effective financial goals, not just dreams out there, but actually measurable goals. And I thought that was a great presentation. So with that, I'm going to back here if she will accept that responsibility. And I see David Paul has joined us and from the UK, and he's ready and willing, I'm sure, to answer your questions well. So Susan, I'm going to make you the board mouse.
Perfect.
And
Dan,
you'll be all
so
set.
great. So I am.
I think you just have to accept that responsibility.
Okay. Okay. Now, can I just check in with you, Stan? There, can you see my screen?
Yes, I can see your screen, and the sound everyone's saying is great.
Okay. And now my next question is if you can see me.
Yes.
Okay.
Yes. Interesting. I can see you, but no one else can.
Let's sort that out then. Okay. So
And I'm just checking on YouTube, and it doesn't show up on YouTube either. So I don't think we're going to be able to see you. Got the webcam on, obviously, but
okay.
I know I've had this experience. Oh, wait a minute. People are chatting in. I can see Susan. Yep,
Oh, great.
no, carry on. I don't know why. Well, it's something with my GoToWebinar, but I don't personally, but everybody else can. So that's great.
Well, that is what is important. Okay, so hello everybody. Susan here, and really delighted to be here. A special thank you, huge thank you to Stan indeed for having me and for inviting me. Would you believe the last time I did this was November 2017. It's hard to imagine. Stan and I were just talking about this during the week that the last time I spoke to you was then, and I particularly focused on Microsoft Europe, sorry, not Microsoft, VectorVest Europe. I have a reason for mentioning that. And at the time, Europe was the center of the world's news at the time, because we were just after the Brexit referendum, and we were also looking at the way in which Europe was powering ahead in the markets at the time, because it had lagged much of the global economy at that stage. So I took people through various ways of taking exposure to Europe through an ETF, through individual stocks, and through individual stocks within Europe and within the US. So today, of course, I'm going to do something very different, and that is that I'm going to talk to you about options. So I have been transacting in options for about 13 years now, and long before my VectorVest journey, dating right back to when I went to university, I studied financial maths and economics. And during that time, we, of course, in our final year, had to put together a thesis. So I decided, I had just discovered covered calls. That's all. I had just discovered covered calls at the time. And then I thought to myself, well, wouldn't it be interesting to explore the impact of options on a portfolio? And of course, naively, I thought that this was pioneering research when, of course, many people had done it before. But the key thing was that I was proving to myself in certain assumptions. And indeed, options can increase your return, but from a mathematical point of view, very interestingly, can also decrease your risk. And when I say decrease your risk, it can decrease your volatility, it can decrease your drawdown, and it can basically smoothen out what is going on in your portfolio. So that is where I started. I started from a very theoretical place. And then I decided, okay, the next best thing to do is to understand how this is happening in reality. So that's where I decided that I would take a look then and to see how I would actually transact in the markets myself. And I'll never forget my first one. I'll never forget it. It was Pfizer, PFE. In fact, somebody asked us about this during the Fantastic Female Fridays interview yesterday. And I sold a put. I got $70 for it. And I got, it was struck at $15 a share, right? So I had exposure of $1,500 and I took in 70. Now, I am not joking you. That was the greatest education in options that I could ever have had. It truly, truly, truly was. And the reason for that is because I was clearly in a position to really feel how it felt. That was the difference. I was really interested in how everything moved and changed and what happened on a daily basis. So that was the best education that I simply could ever have got at the time. Anyway, moving on then from there, since then I have sold lots of puts. I have sold lots of calls. I have put on spreads. I've bought puts. I've put calendar spreads in place. Lots and lots and lots of them. And today, particularly, what Stan wants me to do is to talk to you about selling options. So here's the way that it's going to work. Is that I am, first of all, I'm going to pop across. So now GoToWebinar is telling me that people can see me. By the way, I am taking a look over here on YouTube, and I can see that it's not appearing on, that my camera isn't appearing on YouTube. So that's okay. My voice is, and that's okay. You're, I'm based on some of the comments that Stan has got about having a face for radio, which he doesn't, by the way, at all. I think I'm all good where I am. But before I go on, I have a surprise. Stan doesn't know I'm going to do this, by the way. Neither does David Paul. And hello, David Paul. Again, both of those guys are just absolute legends in VectorVest. But here is what I'm going to show you. And you're not going to expect this. But over here on the VectorVest Instagram, guess what I found? Guess what I found? Scroll down through VectorVest post. Just go right on down. Guess what you'll find? You'll get a picture here of, this is Stan, of course. And this is me. And this is Dr. DeLito. Many of you, of course, will know Steve Chappell. And this is Lara, who Stan and I know very well indeed. So just to let you know that picture is there and it dates right back. In fact, I'm sure Stan will remember this is when we were both in Toronto at the Money Show back at that time. But I just found that memory. So for those of you that can't see me on the webcam, you can certainly find the two of us there right back at the beginning at the Money Show. Now, I can just see as well that whatever has happened, that now you can actually see me on YouTube as well. So hello to everybody who hasn't seen me thus far. And looking at the comments here, it's interesting that people are now commenting the fact that I'm now 20. Do you know what? Let's go with that number. Let's stick with that number indeed. Okay, so let's now get down to business and let's talk through the topic that we have today. So I have three things that I'd like to discuss with you. And please do chat in the comments. I won't be watching them because Stan has kindly offered to do that. So I'm going to check in with Stan every now and again to see what comments are coming in, what questions people might have. And I'm more than happy to engage with you right along the way. All right. Now, first thing I want to do is, for anybody who's unfamiliar with selling options, I just want to make sure that you're comfortable with the terminology and with the consequences and so on. So I'm just going to start off there, make sure that everyone's on the same page. Second thing I'm going to do is I'm going to talk about case studies, but these are going to be 5 case studies from my own portfolio. 2 are still outstanding, 3 I've closed. And of the 3 that I have closed, I have written about them in my views. Now, just as Stan mentioned, each of us around the world has the responsibility to write our VectorVest views. So David Paul does his in the UK, I do mine in Europe, Stan takes care of Canada and so on. But I'm aware that some of you may not have access to them if you don't have access to the VectorVest Europe database. So what I've done is that I've taken a snippet of my views relating to each of the case studies and I've put them on the slides. Stan has told me that for everybody registered, he will email them out. So Stan, I'm not sure how that works for people who are tuning in on YouTube, but you might just address that at a later stage. then the last thing I'm going to do is I do not want to leave you today feeling like, okay, that was interesting how she did that, or how she looked at that, or how one might consider that position and not know how to do this yourself. So the third thing I'm going to do is I'm going to give you 2 step-by-step guides, one for picking stocks for options and one for picking options themselves. Okay, so that's what we're going to do. And I'm hoping that everyone is on board and happy with that along the way. And now I'm just going to get straight in. So let's just think through the characteristics of selling options. There's 3 things you need to know. Okay, number 1 is when you sell an option. So whether you sell a put or a call, and I'm not going to explain what puts and calls are, because I do know that lots of you have been coming to this user group for quite some time, looking at some of the comments coming in there through GoToWebinar. A number of you are already subscribers to the various different options, scenarios, or courses that are on offer with VectorVest and so on. So I don't want to take up the valuable time that I have with you for going right back to the beginning. But all I want to say is that when you are selling options, 3 things happen. One is that you generate premium. And this is one of the beautiful things about options, is that I can pick up the phone or I can go onto my trading platform right away and I can generate revenue. I can generate income. I can push a button, I can sell an option, and the money will be in my account immediately. However, it's also important to know that when you do that, as you can see in my next point there, is you immediately take on the risk. So, at the beginning, I used to say to my husband, oh, this is great that I've just, taken in $1,500. And he said, yeah, but you don't own it. And he's right. And that's the point that I want to make about selling options, is the money appears in your account, but you don't own that money. It is basically rent that is being paid to you. And what that rent is doing is that it is using your risk profile and your existing capital. And it's basically putting a stay on that and saying, right, I may need, Susan, for you to do something in the future. And if it's a put, that means I may need you to buy a stock off me in the future. Or if it's a call, well, then I may need you to buy the stock off me or to sell the stock to me in the future. That's what happens when you're selling an option. You're saying to the option buyer, okay, I am willing to do what you need me to do in the future. Now, of course, you're going to be well aware of what that is. You're going to know the strike price. You're going to know the expiry date. You're going to know the stock. You're going to know the volume of it. You're going to know all of that. But at the same time, by selling the option, you get paid up front, then you take on the risk of doing whatever you have said that you have the obligation to do if the option buyer decides that they want for you to do that. Now, all that said, you can get out. And I noticed Michelle from Belgium. Michelle, you asked me a question there, and Michelle is a regular at our own QA. We have our own European questions and answers session on a Sunday. And Michelle asked me a great question, and he said, as per a general rule of thumb within the VectorVest options systems, do I take my profits when I redeem 80% of the value? Now, for those of you who are not 100% sure of what that question means, let me explain. So I sell an option. I agree to take on the risk of doing something. I'm going to get paid. We'll get into the individual case studies of that in a moment. So then I get paid. Okay. Now, the thing is, though, is that as time moves on, the value of that options contract may decline. Right? It may fall in value. Again, the case studies will clarify this. However, I don't have to stay holding on to that risk. I don't have to do that at all, because I can buy my way out of it. So if I sell an option, let's say, I was going to say today, but of course I couldn't do it today. I'm going to sell an option in August 2020. I can buy that option back in November 2020 and simply clear out my position. So I can buy to close. So all I want you to know at this stage is when you sell an option, whether it's a put, whether it's a call, if it's a covered call, if it's a put secured by money, whatever it might be, when you're selling an option, you do generate money up front. You do take on the risk. You will know what the risk is. It will be quantifiable, as in you know how much of a risk that you're taking on, because you know the strike price, you know the number of contracts that you've sold, you know the expiry date, and you know the stock. So you will know it, but you do need to take it on. And then you take on that risk. However, if you want to get out of holding on to that risk, you can close off at any stage during the period. And that, by the way, I just want to make this point, that exists for both US and European options. Sometimes there's a little bit of lack of clarity about the difference in between the two. I can at any stage, before expiry or before the stock is put to me, I can buy my way out of that option. I can buy my way out and I can close my position. Okay, so that's the theory. Let's get into the case studies now. But they're the 3 characteristics of selling options: generate premium, take on the risk, and then you can buy to close. Okay, so I'm going to go to my first case study. Then what I'm going to do, Stan, is I am just going to check in with you to see if there's any questions or comments that you want to put to me. But I just want to go straight into our first case study first. Okay, and that is this particular stock, Carnvial. Right now, I don't know how many of you were following Carnvial, a cruise company, that was a really big story right back in March, because of course it had the ship that had a number of people on it with COVID-19, and of course due to the contagious nature of the disease, then that ship had to dock and wasn't allowed to move forward. And of course, since then, cruising as an hobby has simply stopped. Right now, I came across Carnvial. I didn't come across it in the VectorVest system. I came across it in the news because all of this was going on, right? Oh my God, all of this conversation was going on. Now, as you can see back up there in February 2020, it had a share price of around about $50 at the time. And the price fell well below 10, right? If at one stage it went down to around about 8 something. So anyway, I came across this stock in the news. And one of the things I love about VectorVest is that I can take, like Stan mentioned there about the emotional nature of investing, but I can take a very emotive story, right? And the story was Carnvial was just absolutely, it was going into free fall. It looked like there wasn't going to be any revenue generated for 2020. Back in March, this was a big deal. Of course, now we don't know if it will generate any revenue in 2021 either, but stock, as you can see there, collapsing. So I was watching this, read a story about it, and that was that. But I used the VectorVest system to objectify emotion. So rather than the sensationalism of the news, I was looking at the stock for a different reason. So I had to read the story anyway in the news, and I said, it's interesting. But then the next day that I was reading about this, I saw that the Saudi Arabian government had taken a 12% stake in the company. And I said, okay, that's interesting. So again, at this stage, it was simply interest. However, then what I did was that I had a look at the RT, right? Now, I have all of this documented in my views, by the way, and I'm going to, the views here are in the stock, are in the PowerPoint. So all of you will have access to that. But here's what I noticed is that the RT, and that's why I have the graphic down here, the RT went from 0.02 to 0.1. So it basically multiplied by 5 in 2 days. So I was looking at this and I was saying, right, the RT has really come off the bottom, like from a very, very low level. I watched that RT back in April. It was the 9th of April that I took a position. I watched the RT and it inched up. Was inching off the ground. It was just, when I say it was inching in terms of the number, but the speed at which it was changing was very, very rapid. So then I thought to myself, it's interesting here that investors seem to have written off this company, written it off. And by the way, I spoke about this stock at the Dublin user group a couple of weeks ago, and somebody said to me, seriously, Susan, you looked at this stock? And I said, exactly. That's the point. Is that people had written it off. They said, who in their right mind would want to go cruising now? And I said, well, lots of people would want to go, but that's not the point. A lot of people won't go. And even if they wanted to go, they can't go. The point was many people had just completely dismissed the stock. But you know yourselves what can happen then. The stock can be oversold. So I watched this closely. And then what I did was that I went and I took a look at the option. And here's what I found, right? Is that I, on the day that the share price was $12.42, I found a July 2020, so this is in April, I found a July put of $12.50, and it was offering me $3.55 after costs. Now, that meant between April and July, I would have generated a 28.4% return. And I said, wow. Now, also, if you look at the effective price, if I ended up taking on Carnvial, then I would have been buying the stock at around about around about $9. Now, I also looked, if I go back up there, I also looked at where the share price, the lowest possible place it had gone was 8. So I said, you know what? While I don't like the idea of necessarily buying the stock outright, not at the price it was at the time, around about 12.20, 12.40, I said, that is a very good compensation of taking a risk that was definitely a risk. But what it was a very risk-adjusted risk. Risk-adjusted return. 28% in 3 months. April, May, June. And July, sorry, that's 4 months. So at that case, if I was to multiply that by 3, that was nearly a 90% return if I had annualized it. So I said, it's worthwhile. It's worthwhile taking. I said, at this stage, I believe that indeed Carnvial could fall further, but I'm getting extremely well paid to take that risk. The volatility was really high. The time value was just about there, the 4 months. And of course, the price had collapsed. And that was only selling an at the money option. That's all. So I went in and, excuse the water analogy here, but I took the plunge, sold my option, and off I went. Now, what do you think happened? Was it a super risky trade? Yes, but as I said, I was well compensated accordingly. But then look what happened, right? Look what happened then is as it went on, Carnvial went up well over $24, right? So at that stage, I then began to say, well, did I leave profit on the table? Should I have bought the stock? And this is what I ultimately wrote in my views quite recently. I said, well, did I leave profit on the table? And the rest of the views then goes on to look at scenario analysis. So the answer is, yes, I had, right? I had left profit on the table. However, one thing you need to know about me is I generally don't buy and sell stocks in a short period of time. I generally take positions, with a view to having a medium-term outlook on this. So unless I had sold up here at the peak, unless I had done that, if I was looking at Carnvial in my normal way of a medium term, well, then I wouldn't have taken that profit at that stage anyway. Interestingly, people were emailing me after they had read the views and they had said, oh, Susan, when are you going to get out? And I said, just remember, I sold an option. So if I was going to take on that stock, I was getting a really good financial cushion through the premium. And I said, that stock doesn't expire until July. And sometimes people confuse the two. Because if you sell a put on a stock, that's not the same as buying it. Because, of course, if you sell a put on a stock, the maximum gain you can get is a premium. Whereas on the other hand, if you buy the stock, the maximum gain you can get is unlimited. So anyway, on went time, and look what happened to stock. It fell right back again. Now look where it is. I took that screenshot when the market closed yesterday. It's $14.22 yesterday. So now the question is, did I leave revenue on the table? No, I didn't. No, I did not. I got paid $3.55 to take the risk that stock could fall below $12.50. Did it during that period of time? Yes, it did, but not for long. Now compare if I had bought the stock $12.42, and now as you can see, it's about $1.80 higher. Instead, I took on $3.55 to wait until July to see if I wanted to buy it. And to go back to Michelle's point, no, I didn't wait that long because the stock had gone way up, as you can see. I simply closed out my option. I think I took about 87% of the profit on that particular transaction, kept the money, and off I went looking for it again. If you're going to ask me, will I be taking position in Carnvial again? No, I won't, because it was, as you can see, it had a sell recommendation. I mean, the PE ratio was, of course, off the charts because you couldn't tell if the stock was going to have earnings, if it wasn't going to have revenue. We all knew where that was going. This stock just was a bottom fishing middle of April. Everyone had thrown in the towel. Despite what the people at the Dublin User Group had said to me, it was, because they said to me, was that not a hugely risky trade? No, it was actually quite a conservative one because it was oversold. I was clear, it was oversold. I watched the RT rise. I looked at a really juicy premium. I had, technically, the stock would nearly have had to break its lowest point for me to go into a position where I would have lost money on the stock if I had to buy it. So therefore, it actually was quite a conservative transaction. But my point was, my point is that through selling an option on this, I actually did better than buying the stock and holding it, even though it went through that period of time. And you see all that volatility that would have made you, roll around your bed, staying awake at night. I got paid for it. And I got paid well for it. So yes, my Carnvial story has worked out. As I say, closed off the option and kept the money and went looking for another opportunity. So my next case study is Twitter. Just at this stage, Stan, would you mind just checking in with me? How are we doing in terms of any questions or comments at this stage?
Hi, Susan. Yes, it's going well, and some nice comments coming in, but we do have a couple of questions. So let's see. Got to look at my flags here, but Lawrence was just asking again on Carnvial, sold put.
Yes.
And so I guess the different scenarios, if it had gone up, what would have happened?
Okay, thank you for that, Stan. And that is precisely what I put in my views. So I've just put up a screenshot of them. Again, all of this is available to everybody. So on the 29th of April, because I actually documented the scenario analysis, on the 29th of April, the price had hit it was 16.83 at that stage. So if I had bought the stock, I would have made 441. But remember, I would have needed to sell the stock at that point as well. And I know I'm not a buy today and sell in a week's time sort of a trader. It's not in my nature. Also, by virtue of the work that Stan and I do, we tend to be quite busy people, which we're grateful for. But it just means that I wouldn't be watching my portfolio every single day or deciding at which specific technical analysis point to be taking my profit. So I probably wouldn't have sold on the 29th of April. And I would have been kicking myself if I had, because a couple of weeks later it was up at 24. However, on the 14th of May, the stock had fallen to a low of 11. Now, at that stage, the put that I had sold, so I had, just to clarify, by selling a put, I mean that I had agreed to buy the stock off the option buyer in July at $12.50. So by the 14th of May, the share price at that stage had gone to 11. And since then, as a result of that, if that day was the expiry, immediately, of course, the option buyer would have sold it to me. Now, the thing is, though, is that if I had bought the stock for if I had bought the stock for $12.50 and the stock was only worth 11, I was now down $1.50. However, remember, I got paid $3.55 per share. So therefore, I was still going to profit at that stage. And then from there, at a later stage, then the stock went way up to 24. At this point, the value was almost practically gone out of my option. My option was pretty much worthless, because who in their right mind would sell a stock to me at $12.50 if they could sell it to the market at 24? So at that stage, of course, we had really rolled on, and the value of my option was really, really low. So I simply bought it back, kept my premium, kept my profit, and off I went. So I hope that clarifies there, Stan, either through what I've said or through what I've written up there. That's not the end of the views, of course. I couldn't fit it all onto the slide. But yeah, in essence, the scenario was, if the share price had fallen below $8, I would have been losing money. If it was anywhere between $12.50 and $8, I would have had to buy the share for sure, but I would have been profitable. Anywhere above $12.50, I wouldn't have had to buy the stock at all, which is what happened, and I kept my premium. And we all lived happily ever after.
Okay. Yeah, and Jerome just made the comment here. His perspective, he doesn't sell puts stocks that he wouldn't want to own. And
okay, great point.
so,
yeah.
So Carnvial was an interesting choice because of the COVID crisis affecting cruise lines.
Okay, excellent point. And it's one actually. Sorry, what did you say that person's name? Jerome. Yeah.
Jerome.
Jerome, excellent point. And I have to say, I agree with you. Right, I generally sell puts on stocks that I'm happy to own, and we'll talk about that in the next case studies. The reason that I picked Carnvial was, would I've been happy to own Carnvial at an average entry point of about $8? Yes, I would, or $9. I would, because it had fallen so much. Is that the Saudi Arabian government had bought into it, It had raised money on the corporate bond market. It was spending about $1 billion a month in terms of maintaining its fleet. It was ultimately a company that was intending to operate. It had got buy-in from investors from different phases, but it was so oversold at that stage. And I could see the momentum through the RT was rising. So from that point of view, is that if I had bought it at that price of $9, that entry point of $9, which is $12.15 minus my premium, I'd still be up pretty well today. So I would have been happy to buy it at that, but I wouldn't be buying it today at 14. I don't need to. There's plenty more fish in the sea as well. So, but it is an excellent point, and it's one that I constantly put myself to that test, as you'll see in the next number of case studies.
All right. So, maybe we'll move on, because I think some of the questions I see now will be answered in subsequent slides.
Okay, perfect. So the next one is Twitter. Now, here is one of the challenges of options, is that question to ask yourself around, where do I position my strike? Now, if I want to buy the stock, but if I don't mind if I don't get the stock, I generally sell at the money. Okay, so this is what I did with Twitter. Twitter, I have to say, as a technology, I think it's brilliant. Stan is somebody who's certainly on Twitter quite a bit. I love Twitter. And I actually do a Twinterview, which is an interview with the VectorVest team every 2 weeks in advance of Fantastic Female Fridays. It's where I get my news. It's a place where I interact with a lot of people, and on and on. But anyway, that's nothing to do with the stock. So I was quite familiar with the company. And then I looked into Twitter and how it was developing. So one of the lovely things about the VectorVest system, particularly when you're selling options in a relatively short period of time, is RT. RT, relative timing. It just gives you the direction and the dynamics, and also it gives you a sense of the volatility of the market. So it just basically says, right, what's the direction of the stock? Is it going higher or lower? Secondly, what is the magnitude of that? So is it going high, fast, or down fast, or is it just kind of bobbling around the place? And also the dynamics. How is the momentum and the volatility woven into that? So as I looked here on Twitter, it was interesting that I could just see the RT was just, look at that beautiful period in between April and June. And so I looked at Twitter and I said, okay, I can see the stock is, rising there 20 to 25. And while that's a 25% gain, that actually back in March was a pretty tempered rally. I mean, I think a lot of us can forget. I certainly know I can. You can forget what life was like at a certain period of time quite quickly when things are constantly happening, as they have been this year. So at the time, anyway, I was watching the stock, and it was, up and down and up and down, but it was moving in the right direction. The RT was good. So then I decided to take a position. I said, okay, I'm going to sell my put. And I said, I would be very happy to take on Twitter. Had it before. Ardal, by the way, is my husband. Ardal and I have discussed Twitter before. We bought Twitter all years ago. I think we bought it around about $11. Then we had sold out at 17, which was a good place actually to take. Then we went back in again. I think we sold at 30. The price subsequently fell. And then I was saying, you know what? Maybe now is a good time to get back in. So looked at the RT, and then the question is, where do you put your strike? So do I strike whereby, do I sell the stock at a strike price whereby it is in the money, out of the money, or at the money? So at the money means where it's at today. Do I do that? Do I just sell a stock? Sorry, do I sell an option, a put option, to buy the stock at the price where it's at today? Because in a market like that, it's quite likely that my option will be out of the money. It'll expire worthless. I'll keep the premium, but could I lose out in the gain? The other alternative is, do I not want the stock really? Do I really not want the stock? And if I don't, well, then I'll sell it out of the money put. I keep a little bit of premium, and, we'll see after that. Now, I generally don't do that, because if I don't want the stock, a bit like Trump, if I don't want the stock, at the end of the day, I don't want to be in a bullish position in the stock or acting like a bullish position. Now, if I really want the stock, if I definitely want the stock, then I go in the money. I will agree to buy the stock at a higher price. I'll get a lovely juicy premium for it, and I'll basically get paid to wait to buy the stock. And if the price goes higher than that, well, then that's the risk I take. So here I was thinking about Twitter and what would I do. So this is ultimately what I decided. Now, I never buy a stock without checking the VectorVest system. I don't think any of us who work with the company could say that we do. We might decide to buy a stock for a different reason than the system generates, but certainly in my case, I'll always look at the system. So I had watched it, right? And if you look here down here to the middle part of the essay, the relative safety of Twitter was round about 0.85 and had moved upwards since October. So the impact of COVID-19 didn't affect the RS at all. And the RS is a wonderful, wonderful indicator to really check. That's, I suppose, Jerome, to go back to your point, that's the real litmus test of, do I want to have the stock or not? Do I want to have a stock that has consistency and predictability of financial performance? So I thought, yes, I do. But I was watching the RT. That was particularly what I was watching. Well, I was really watching this back in March because it was so hard to talk about proper fundamentals. Like Twitter was not truly going to be largely affected in terms of its user base during. What I mean by that is it's people who are contributing all the time to its Twitter feed, like me. But of course, it could be by its ads. So I wanted a company that had resilience for sure. But I was watching the RT to decide where to strike. So what I did, now, I also, by the way, I must let you know, there was a typo that went into the views where these currencies should be in dollars, not in euro. So, and I just spotted it when I was taking the screenshot of this. So apologies about that. All of the figures are dollars. So what I did was, the strike price at the time that I decided to take was $25. And the strike date was June 2020. The premium was $2.63. So if I go over then, let me go over here to what was going on in April, or sorry, let me go back up here. So over here, I struck it at the money in the end. I said, right, I'm going to be happy to take on Twitter, but I'd also be happy to get paid regularly to take on Twitter. So I'll do an at the money put. If I don't get the stock, I'll sell another option on it. And I did. So I sold there at $25. I got $2.63 per share. And of course, in every contract, there is 100 shares. So that's what I did. Took it, and the stock just kept on rising. So then, just like Michelle asked me there, I took that off the table about 5 weeks early, and I had 87% of that money. Because it cost me 13% of the option price that I had taken in premium to close the position, and that was it. And then that's often what I do with stocks that I like, is just keep on taking premium after premium after premium after premium. I have another one that I'm doing that currently with in Europe. I have a stock that's the highest VST stock in the database from a couple of weeks ago. Did that, sold an option. It expired, or it almost expired worthless. I let it go to about 2 weeks beforehand, and I just took it off the table, sold another one. So that's a lovely way to generate income, time after time after time, quarter after quarter after quarter. And just Twitter is an example of that. Before I go back to Stan to see if there's any more questions, I'm just going to show you one more case study where I'd like to talk to you about. And then I'm going to show you 2 live options that I have outstanding at the moment that are, just really nice for the current sort of market environment. And I'm conscious of time, of course, as well. But just after I go through the next case study, Stan, I'll go back to you to see if there's any more comments. Right, this one. Now, this one was a totally different kettle of fish. Hecla Mining. This I spoke about in my views this week. Look at the shape of that graph, right? Now I have zoned right in here because I'm only showing you from the end of May to yesterday. At this stock, oh my God. This was an example of, I had never heard of Hecla Mining before, right? Even when I came across the stock, people weren't necessarily talking about gold the way they are today. Now everyone's talking about gold. It's the front page of the Financial Times. I was on Trending Thursdays 2 weeks ago with Glenn. We spoke about gold stocks. I have my own personal view on that, of the way in which to take a position in it that would be a little bit different than others. So anyway, we spoke about that during Trending Thursdays, etc. So let me go back, right? Let me go back to May. So in May, this stage, I'd taken my Twitter off the table. I had taken my Carnvial off the table. A number of them at this stage I'd taken off the table. I was looking for new opportunities. And this time, I was looking for a different approach. I said, right, how about this time? what I would do is that I would look for high VST stocks. Okay, so I wanted value, safety, and timing. Jerome, back to you again. I wanted stocks that I was happy to own. But this time what I was going to do was I was going to find the fastest moving stocks in the database. So I was going to, I set my unit search for VST over, I wrote about it, and let me see when, yeah, there it was, the 18th of May, 2020, got a confirmed up call. The 19th of May, put together a unit search. I wanted my VST above 1.9. I wanted my relative safety above 0.9. But after that, I wanted to get, I wanted to go by RT. Okay, I want to go by relative timing. So I got this top stock. I got the top stock in the database, which was Hecla Mining, fastest moving stock in the database, subject to the constraint of VST above 1.3, of which there was several, and RS above 0.9. That, obviously the fact that I couldn't go over 1, I didn't have that many candidates, just showed you how difficult it was to find consistency and predictability of financial performance at the time. So I went and had a look at Hecla Mining. Beautiful premiums. Oh my God, beautiful premiums on offer. But they were small, right? The stock was small. So I took on, I had to take on a good number of contracts this time. So here's what I did. Top stock, again, in this case, the numbers are in euro, they should be in dollars. But anyway, so went looking for my RT, and it was the second top stock. You know what? Can I just clarify what happened here? It was the top stock on the 18th of May, and on the 19th of May, it was the second top stock. So anyway, went into Hecla Mining, and at the time, the stock traded at 3.35 a share, right? And I sold an at the money put, but slightly out of the money, at the money, same sort of, slightly like at the money, it was 3.35. Let me see now, 5th of August. So on the 5th of August, no, that's wrong. On the 19th of May, apologies. So on the 19th of May, back here, it was around about 3.20, and I think I sold it at 3 or somewhere around that area. And I got 49 cents per contract. Sorry, got 49 cents per share. And I sold a range of contracts. And that was it. I just simply said, all I'm going to do is I'm going to get paid to wait to see if this momentum continues. And if it doesn't, I was going to be able to buy that stock at approximately 270-ish, that sort of an area. And look what happened since. Am I glad I sold the put? Yes. Do I prefer if I had bought the stock? Yes. And this is the thing, is that this is often the case, is that when you see a stock that has just taken off, like just practically doubled in that period of time, you think, oh God, why didn't I just buy it instead? Now, the thing is though, is that as a very disciplined options investor, which I genuinely am, the only time I don't sell options is when volatility is on the floor and I'm basically getting nothing to take on that risk. I may as well just buy the stock because I'm not getting paid anything to wait if it's on the floor. But other than that, I sell options, and I'm disciplined at it. I'm very disciplined at it, and I watch them, and I watch them from the point of view of how the option is developing as opposed to just the stock, right? I am very, very disciplined that way. So I didn't want to come on today and say, oh, look at all these great options transactions that I've had, and they've never gone wrong, because that would be false. It would be false to tell you that. And I want to tell you, A, the truth, and B, sometimes when I thought, geez, couldn't I have done this a better way? But when I show you my next 2 live cases, you'll see how that discipline is rewarding. Just like dollar cost averaging, is that if you get in often enough, you will simply take advantage of the average. The highs will be great and the lows won't be as bad when you're somebody that has a consistent approach. And in my case, I do. So anyway, as you can see here, in the case of Hecla Mining, the stock is now, it hit a high of 6 something during the week, and as you can see, then yesterday it fell back down. I don't know where it's going to go, but like still, its RT is up at 1.91. I mean, and I won't be selling another one. I'm looking for different opportunities now, because the fastest moving stocks in the database, subject to those constraints, have changed. And of course, I'm not somebody that simply looks at a stock and says, right, I'm just going to do it again because it was good to me last time. That doesn't make any sense. Every time I run a search, I look for the new opportunities, and I don't. Some people do this. They think, well, Hecla Mining was good to me before, so I should just do it again. That's not the way I look at it. I look at it as the search was good to me before. Let's try that again, and let's see what the approach is that I would take. So I wrote about that, as you can see. I specifically spoke about this, spoke about my rationale, and so on like that. And from there, I'm going to go back to Stan at this point. Stan, can I check in with you? Anything that you want to ask me at this stage before I move on to my 2 live case studies, the ones that are outstanding?
Yes, the questions are coming in fast and furious, which
Great.
is great. I've picked out a few here that are general. I'll just start with the last one, which is interesting because you just finished the Hecla example, and it's a lower price stock. So the question, and it came from a few people, is on more of a speculative lower price stock like Hecla. What criteria and interest and premium might help decide to take?
Yeah, okay. I don't look at open interest at all. I'll tell you what I do look at, and I do look at this very, very closely, is the bid-ask spread. That's what bothers me, is if I have a really wide bid-ask spread, I don't want to, like, as you've probably gathered from me now, I don't often leave stocks or options to expiry. So therefore, I need a relatively tight bid-ask spread so that I can get out without spending a lot of money that is just going into a bid-ask spread, and therefore the volume will determine that. So I don't look at open interest. I simply look at that. For example, I just thought, you know what, everyone should have some core holdings in their portfolio. One of the ones that I got from my mother years ago was the World ETF, IOO, the S&P 100 World ETF. And I thought, you know what, that probably would be a good one. Let's get in, selling at the money put for IOO. Oh my God, the bid-ask spread on that was ridiculous. So that was it. That was the end of it. I decided, no, I'm not going to take an option there. Now, the other question you asked me there, Stan, was around premium. Now, I do have rules there. And if it's okay, Stan, I've created actually a Google Sheet with those rules. So I'm just going to hang on until at the end of my next 2 case studies, and because that would be a timely time to introduce that. So if that person could just hold on with me.
No, that's fine, but there is kind of a related question, Susan, and it's from Bill, Vancouver, and he's just wondering, do you always take off your short puts before expiration, and if so, what is your?
Yeah, no, I don't. I don't take my puts. I like the 2 I have on at the moment. Both of them are expiring in 2 weeks, but neither of them, the 2 I'm going to tell you about, neither of them have delivered 80% or more yet. And therefore, and both of them are out of the money, by the way. Now, they are close and have been, bobbing up and down over my strike over the past week in particular. So for a start, I don't close an option unless I have 80% of the value. The second thing I would say as well is I always go into an option with the view that I want to take on the stock, even in Carnvial, and I proved that. But that view may change over the time period. As time elapses, that may change. And if that changes, I'm out. So if I would look at a stock at a certain day and I would say, you know what, I wouldn't buy this if I was to put $10,000 into the stock, would I do it today? No, I wouldn't. Well, then why would I have an option? Why would I have an open position in it? So that's the second thing is if that happens. And that pretty much determines it really, Stan. It is whether I still want to have it. And I do, by the way, I have gone on to buy stocks as a result of expiring options that were in the money and have been happy to do that. And then, of course, I'm in the wonderful position that I can sell calls. Happy days.
All right, great. Well, Fred just made the comment, this is really good. She has a great way of explaining things, so that's awesome.
Thanks, Fred.
I've had a few people ask about, do you have a favorite search that you might use for finding the best candidates for selling premium on?
Well, I'm really glad people are interested in asking me that, because that is the last part of my presentation today, are 2 step-by-step guides. So I specifically have a number of searches in the VectorVest system built for that. Yes, for sure. And I also have not a search, but just a quick way to look in viewer as well. So just like in the case of that previous question, stay tuned. Don't go anywhere. If you're going to get a cup of coffee, make sure you're still watching while the kettle is boiling, because I will make sure that we get to that before 12:30 Eastern time as well.
Okay, and I think it kind of relates to that a little bit. That Bob wanted to know: do you trade stocks and options and use the same type of selection criteria?
Yes, Bob. I'll tell you a time when I wouldn't sell an option, but I would buy a stock, and that is if it's not optionable, obviously. If the bid-ask spread is too wide in the option that it just isn't worthwhile. There are two examples. Another one would be if the share price doesn't fit. Like if I'm unlikely to be selling a put, let's say, on Berkshire Hathaway, where I don't know what the share price is today, but it was all over the front page of the Financial Times today saying that their profit is up 89% and so on. Like, I mean, if you're going to take on a share like Berkshire Hathaway and you have to agree to buy at least 100 of them at the time, that can be a pretty substantial amount of your capital. So sometimes just selling contracts of round lots of 100 just doesn't fit. So, and some examples of that, by the way, I mean, I noticed a couple of you are commenting on my accent, and yes, I am the real deal Irish, and yes, it is not a mistake that I wore green today, of course. So I can't sell options on a number of Irish stocks, and Ardal and I we do have positions in a number of stocks where if I was just to wait and to find an option, I would be waiting forever, or else I might have to go OTC to the broker. Don't want any of that nonsense. I just wanted to take the position. So to summarize, if the bid-ask spread just means it's infeasible, or if, just like I mentioned earlier, if the volatility is flat, 2020 was so not a year for flat volatility. Secondly, if options aren't available, and then thirdly, if taking on a round lot of options just doesn't fit with the amount that I want to put into the portfolio, then I don't either. Now, he also asked me a question about my stock selection criteria. They're pretty similar, Bob, to be quite honest, because I'm only going to sell a put on a stock that I want to buy. So therefore, I have to be cognizant of that as well. If I can get a lovely juicy premium along the way, well, then that's great. But I don't let the tail wag the dog. I don't let the juicy premium determine if I'm going to take on the stock. It's always important. It's always important to go back to Jerome's point there as well.
That was a really important. Thank you for that. Oh gosh, there are so many great questions. I love that about this forum, that we get so many wonderful questions, and we may not be able to get to them all, but best here.
Perfect.
I think this is an important one, and maybe then I'll let you move on with more to come. But Colin is wondering, when selling a cash covered put, your goal, the income, as potential longer term investment. I might have just touched on that, but me a great question.
No, Colin, you're right. You're right. You're right to ask me that for sure. And a lot of the time it is income. Because as I'm going to show you, actually, well, since Stan has said that was the last question before I move on, let me do that and let me answer your question with the next case study. So this is a case in point, right? You remember when the oil price was falling into freezing, right? Do you remember when it fell below zero? Suddenly it was a cost to hold oil. So remember Ardal and I talking about this. By the way, Ardal taught me how to invest before I knew VectorVest. And it's a real shared passion that we have. Can I actually tell you a story, right? He's not here, so it's okay. Well, it wouldn't matter anyway, but I just want to tell you this. We chose to go to Chicago on our honeymoon. Do you know why? Because his friend found a way for us to get a guided tour of the options trading pit in the SIBO. That is the reason that we chose to stay in the loop. That was the reason that we chose to go to Chicago. So when I say it's a shared passion, it genuinely is. He's really interested in the stock market as well. So I often talk through my thoughts with him, and he'll often do the same with me. And then we'll go through the VectorVest system and see what the VectorVest system thinks, and then we'll take a position after that. So anyway, we were talking about oil, and he says to me, "I think we need to take a long position in oil." He said it can't go anywhere but up, and I said, "I'm uncomfortable. I'm uncomfortable going into oil." I said, "We don't know enough about it. And a lot of the oil ETFs at the time were disbanding. And further, I said, a lot of the oil ETFs are based on the futures price, and you're baking stuff into a pie. I said, I'm just not comfortable with it. So I proposed this, XLE. XLE is the S&P Energy ETF, right, Colin? And in this case, I said to him, I feel energy is going to rise as an entity, and I would be happy to take a bullish position in it, but I would be even happier to just take the income. And this is one of the live ones that I have right now, Colin. Now, look, see where it's at now at the moment. It's at 37.18. And just going to show you the Google sheet that I told you that that I have here is that right now, my strike price, because I have, these are three that I have live at the moment. So this energy ETF, the share price is 37.18. The premium we took in was $4.75. And as you can see here, my strike price is 36. I still have this outstanding. And I checked the value of this. I checked the value of this before I came online. This is currently worth 69 cents at the moment. About 69 cents. So I'm very, very close to pulling the plug on this. But as you can see, like it's $1.18 out of the money. And still that there is 69 cents left on that. And, you know, I'm just thinking, the volatility on this has been high. Like, look, it doesn't look it on the graph because that's where it fell when oil was falling. But look at the volatility on this. In 2 weeks of time, there is still a significant amount to be taken in this particular option. So I, in this case, was completely happy to not take on XLE because I think energy is a rock and roll sort of a business at the moment. There's a lot of volatility in it. I was simply happy just to take the income on this. And at the moment, that's looking like what's happened. Now, what I'm going to do is I just want to, because it's live, I want to take you through, I'm going to take you through a graph of that stock, XLE. And look, I've been looking at this stock every day for the past week. So let me just show you what like the last couple of days have been like. It's been like this. So here it's been, 38.26, well out of the money. Then, or was this Tuesday? 30? No, that was last Thursday week. Then as you can see here, then the low price, 35.29. Like, so the thing was, here we were, then it went up a little bit, then it went up a significant amount, up, down, and this has been just what it's been like. The RT, as you can see, is a 0.74. So here is one where this is my strike at 36 over here, and it's broken down through 36. Let me just put a line there. Let me just insert, or you know what, maybe I'll just do this really quickly. Back here to about 36, yeah. So just look at that line. Look at the number of times that it's dipped down over that. Where then I thought, okay, you know, I'd say to Artel, do we really want this? Do we not? Now, I will say, I don't think that this option has ever gone negative on me because the time value and the volatility has compensated for the decline in price. So it's never gone negative, but there was a couple of times when really the value or the change in the price was very, very little. But at the moment anyway, to answer your question, Colin, I'm quite happy to let this expire worthless at the moment, because I think if this price just keeps kind of bobbing around the existing area, I won't be able to buy this back for very little until close enough to expiry. So that's my position there. Now, on the other hand, this is a different ball game. Is paychecks. Let me just get this. This was one that Arden came up with. He said to me, well, you know, just take a look at this. So I specifically took the screenshot here of what the stock was like on the 20th of May. Because on the 20th of May was when we took the position here. Now look over here on the right-hand side, right? Look over here. Relative safety of one, paychecks, by the way, is payroll software in the US. Relative safety 1.17. Earnings per share of 325 per share. Dividend yield 366%, 3.66%. I love generating income, whether it's selling options or whether it's dividends. I just love it. P ratio, beautiful PE ratio here, just over 20. DST of 1.17. Now, Colin, what is there not to like here? So in this case, I was really happy to take on the stock. So now, and I sold out of the money. Sorry, I sold in the money, well in the money, right? Now, where Arden and I discuss stocks, it's me that runs the show when it comes to options, because this is an area that I'm really proficient in, as hopefully you're seeing at this stage. It's an area that I really enjoy, and I'm quite a mathematical mind, so he leaves that bit to me. So I haven't written about this in my views yet, but I will. But I want to show you where we're at currently with it in my Google Sheet, because paychecks currently, I've pulled I set up this Google Sheet, and you can, through this function up here, you can actually pull in the live prices as they're happening. So paychecks is currently 73.45. I struck it at 72.50. Now, I was saying that is quite a significant increase in price. So I struck it in the money at 72.50, and with 13 days to expiry, which is of course 10 trading days, 13 days to expiry, it's now out of the money. So of course, anybody who has bought an option is not going to sell the stock to me at $1 less than they could to the market. So at the moment, it looks like that one is out of the money, and at the moment, of course, would expire worthless if today. But I don't know what's going to happen by now and next week. While I'm on this situation, just to talk to people as well about what I look for when I'm apart from the stock itself. So in the case of energy, Arda and I said we do want to get into energy some way. I didn't want to go as niche as oil. I want to go somewhere more diverse. And I said, if we were going to take on a stock, something like a general, well-run ETF like the S&P, I was happy with. So you see here what we did. So what I did was then, of course, it came to look at the premium. How much of a premium were we going to get? And the answer is, so the premium I got for this was $4.75. And what I do is that I divide that by the strike price, right? So you can see the function I have up here in my Google Sheet. So I take $4.75 and I divide it by the strike price. The reason I do that is this is the money I'm going to take in, but this is the money I'm going to have to pay out if the stock is put to us. And as you can see here, like this was a fantastic return of 13.19%. And the expiry was August, I think. Pretty sure we sold this in April. I have to go back and check. I'm pretty sure we sold it in April. So April, May, June, July, August, 5 months. Now, generally what I do then is it doesn't make sense to leave this on the sheet. So that's why I wanted to show you exactly. So then what I will do is then I will divide this by 5 divided by 12 to annualize the return. So you can see here is that if we were to repeat this right throughout the year, we would make 31% return. And that was simply selling at the money. So if the stock did nothing, we'd get 31%. Now, of course, just like in Hecla Mining, and indeed like in Twitter, of course, the stock could go higher than that. Of course it could. But remember, I am the what's the word I'm looking for? Disciplined options investor that I am. So I like getting paid to simply wait to see if anything will happen. And you know what? Generally in options, the way in which I do it anyway, where I make sure that I get a significant premium to take the risk, or I only sell options and positions that I'm happy to take on, and I'm consistent. Quite often I may lose out, but I may not lose over time. And that certainly is the case here. So far anyway. Okay, so far. Now, in the case, you see, this is why I want to show you paychecks then, right, is look at all those fundamentals, like I said, beautiful fundamentals. But look at what happens. Look at what happens to the stock. It's like it went from 67 to 73. But look at what's gone on over the past couple of weeks is a whole load of nothing. Up and down and up and down and up and down, bobbing around its own share price all the time. And the thing is that will get a stockholder nowhere. It'll get them nowhere. Really doesn't get them, essentially anywhere. However, if you're an options investor, particularly selling premium, you get paid for that volatility. You just get paid to look at that stock rock the boat. That's that. And so therefore, despite the fact that Artie says to me, I like the stock, and I said, well, when I looked through the fundamentals, I really liked the fundamentals. Very happy with that. But the thing is that over time, particularly the last month, done nothing. Stock has done nothing, and yet we have taken in premium. So at the moment, looks like we will be expiring worthless. At the moment, again, we'll see what happens in the next 2 weeks. And if I see the value of that option falling significantly, I will take it off the table even before it goes to expiry. I know I could probably make an extra couple of cents by waiting to expiry, and I won't have to pay the commission charge. But On the other hand, really and truly at that stage, I'd rather take something off the table, because we don't know what else could happen. We don't know. And anytime that you leave an option on the table just to save a transaction charge or a couple of cents, you know, it's a really high price to pay if something significant happens there. Now, I'm conscious of time, so what I'm going to do is I'm going to go on and give you my 2 step-by-step guides, and then I will happily take questions until Stan runs out of steam. And we both know that may never happen. So until, certainly, and I'm happy to stay after 12:30, Stan, if people have questions. So my 2 step-by-step guides is this, okay? Number 1 is, how do I pick the stocks that are potential options candidates in the first place, right? So this was a question that I think Bob asked, Stan. So first thing I do is I look at the top VST stocks that are optionable. So now I'm going to bring it to Europe for a moment, right? And come over here to Europe, and quite simply looking at the viewer, right? Just let's go look at the viewer, stock viewer over here, and you can see we have a range of companies here, right? So obviously, it's ranked here automatically by VST, so you can see that we've arranged them. Now, if I go back, let me go back to, by the way, just as Stan said, we had our confirm call there on the 31st, which was last Friday. So I'm going to go back here. I was on Trending Thursdays with Glenn on the 16th, right? So let me go back here on the 16th. And now, look here, ASM International. At the time, the price was 144.70. And it was the second highest VST stock in the database, but it was the highest VST optionable stock. Now, I'm just going to briefly show you a graph on that. As you can see here, so it has fallen off. As you can see here, I did. By the way, I did sell an option on that. It's fallen since, but I sold an option. I think it was around about here in June. I sold it for 125. It expired. I took it off the table with 80-something%. So because it rose, which was beautiful, and then I sold another one up here. But that's all I did to find it. And when I look at the fundamentals again, like, they're nice. You know, I've got a dividend yield here of 1.15%, VST here of 1.28. Look at that CI. Just look at that amazing CI, 1.61. PE ratio of around about 20. I'm totally okay with owning that stock with those types of fundamentals. Totally okay. So that's one way to find them, is that I simply go into viewer, look at the top VST stocks that are optionable. And of course, I know they're optionable if I see the little X over here. And then I dig around after that. So that's one way. Now, 2 strategies I'm also going to point out here. One is ruler stocks for options. That is over here in the US. I'm going to go over here to Unisearch, and let me go to I've hit it twice now, so that, yeah, down over here. So you see rulers. Oh, I knew I did it twice. Let me go to A to Z again. And in here, I'm going to get ruler stocks. So ruler stocks like stocks that are like a ruler. And so you have ruler stocks, but specifically you have ruler stocks for options. Now, I took a look at this before we came online today, right? And if you look at the search, if you run the search, there's plenty of choices. I'm always careful when I'm talking about options to only refer to the word option in the financial derivative sense and nothing else. So I took a look at these, and look, this search is great. Growth rate above 14%, relative safety above 1.4, stock price above 1, good solid volume, eliminates the ETFs that are short, and it comes down here, only looks at optionable stocks, and make sure that we don't have contras, right? What I'll just go back to the question that I think was Neil asked me about, or was it Bob that asked me, what differentiates my activity between buying stocks and selling options? So something here like this type of stock here, $600, that means to sell one contract, I would be looking at a $62,000 exposure. That I wouldn't be comfortable with that. So you can, of course, edit this Unisearch, and just for the fun, I'm going to say that I want a price which is let's say less than 100. Okay, less than 100. Less than 100. Okay, run the search. Let's see now what I've got. So that means that the maximum exposure that I might have then here would be $10,000 contract. So we've got three choices. Logitech, by the way, Logitech, I am looking at it right here because the webcam I'm using right now is actually a Logitech webcam. Then I see TAL, Education, and Centene Core. And then what I would do, I go in here and I would take a look at the RT. Now the RT all over here is looking good. Let's take a look anyway. And let me take a look at the graph. So let me take a look at Logitech. Look at that beautiful looking stock. And you know what? I am not at all surprised that that share price is rising the way it's risen, given the sheer volume of how much time we all spend online now, talking to each other on Zoom and Skype and Teams and so on. So as you can see here, stock has been rising, but I'm uncomfortable with this. I am uncomfortable with this. We can see here a bearish divergence. So I'm uncomfortable with this. This isn't something that I would be looking at right now. I don't like this either. Now this might turn around, but don't like this either. Now, of course, like many of you might say to me, yeah, but Susan, have you not seen the markets over the past few days? Like, have you not seen what's going on with various different geopolitical situations? And that's what's driven the entire market down. Doesn't matter, guys. Doesn't matter. I still, if I'm taking a stock position, well, then I'm not going to, I'm not going to not look at the market direction. It's important that I need to see the stock going in the direction that I need to go, as well as the market timing. And I'm not happy with an RT moving in this direction. I am not looking to catch any falling knife. I don't need to. Now, but the third one, and this is more interesting, actually. This is more interesting, is look at this volatility bobbing around the place. This is interesting from potentially from an out of the money point of view. So the RT has fallen all right, but look, this is since June, well, yeah, since the end of June, the RT has just been kind of bobbing around the place. And this might be an interesting potential. And I'm looking over here, the PE 12, relative safety 1.42, VST of 1.31. So, you know, this one might be interesting to take a look at. And then what I would do is I go in here to Centene or right click, analyze the options, going to look at a short put. And in here then, and this is why I wanted to show you my Google Sheets. I then would edit. I like to put about 3 or 4 months. So I'm just going to go out maybe to November. I used to sell leaps. So leaps are when you go way out here. But I just used to find that when volatility is high in the short term, I find you're better off taking it now. So anyway, so I've got, yeah, okay. And now let's take a look at this. So current premium 276. I'm looking at buying the stock at 60. Stock price is at 64.28. If the stock price at 64.28 and I would be okay with taking on the stock, I would go up one strike, 65. We go. How are we doing now? Now we're talking, okay, 514. So I'm going to go back. Oh, no, not to Excel. I'm going to go back over here to my Google Sheet. I'm going to copy this and paste. So what I'm going to do now is I'm going to put in here, so Centene. Oh, well, I should have put that there, but anyway, that's not a big deal. So the share price currently is 64.28, 64.28. Premium is 514, 5.14. Strike date is November 2020. Strike price I have is 65. Now today's date is that the expiry. See, I have this coded into my Google Sheet, but for the number of days to expiry, so you can see the way I've done that. My expiry date is when? 8th of November. No, that's the trade date. Expiry date 21st of November. Apologies. 21st of November. And that's 105 days away. And there we go. So my return would be 7.91% if nothing happened. And if I annualize that, that is 105 divided by 365. I did this on a full year basis, 365. And that is completely wrong. Of course, I need to divide it, not multiply it. Okay, so that works out at 27%. Now, you see here how I would now compare this to look at for example, when I showed you this with XLE, then in that case, it was giving me an annualized return of 31. And then I make my decision, does this justify it? Would I be happy to take on Centene? I mean, obviously, when I'm looking at this stock, from a stocks point of view, I am well aware that I'm well aware that we are talking about a stock that is in a certain sector, and that is, of course, healthcare. And we all know what's going on with healthcare at the moment, and how that's a changing industry. Obviously, we're down to who gets the vaccine, the impact and long-term health and so on like that, and what people are willing to pay for. So that is how I do it. And I know that's a longer answer to what Stan shared with me earlier that you were asking, but that's how I do it. By the way, I always document why. Always, I document why we were thinking of doing it. So ASM, like I showed you at the top, VST stock. XLE was the energy sector. We wanted a defensive position that was diversified in more than oil. Paychecks, the fundamentals were all right. And in this case, what I would be documenting there is this is ruler stocks or option. Yeah, that would be why. That would be why I would be picking that stock. It's so important. I learned that from the Trade Like a Pro course, and particularly Steve Chappell spoke about doing that, is document why you're taking position, because then if you're deciding, oh, should I stay or should I go, you can go back to, well, why was I in this in the first place? And is that reason still in place? Just a couple of other things to note. Best of the Biggies is another one. Best of the Biggies is another unisearch that's useful because it picks good, solid, fundamentally well market capitalized stocks, and from there it can be interesting then to take a look at your options too. Two things to watch: ensure relative timing is rising. I'm just not comfortable taking positions where the RT isn't rising. At the minimum, make sure it's above 1 and staying there at a minimum, but otherwise make sure the relative timing is rising, and watch the CI. I just think the CI is just such a great way of analyzing stocks. I really do. Like, you know what I always say? Look at this, right? Just look at the viewer. CI is a comfort index. It's a stock's ability to withstand severe and/or lengthy price declines. Lots of people don't understand what that means until you show them a picture. Look at, did I just do that? I did just do that. Let me change that to high CI. CI, there we go. Oh yeah, I did that. Let me graph them all, right? Let me graph all. Graph all. Look what CI means. It's stocks that start at the bottom left and move to the top right. Okay, well, that's a baby stock now. It's not around long, but next one. Similar. Okay, but next one. Now we're NVIDIA. That's another piece of technology that I use all the time. Look at this. Now, I'd be careful. Like I say, bearish divergence here. I don't like it. But in terms of selecting candidates for stocks, look at this. Beautiful. Beautiful again. Beautiful again. Beautiful again. Beautiful again. Beautiful again. Beautiful. I'm saying beautiful again before I see the stock, because I know what will happen. The CI find stocks that start at the bottom left, simply move to the top right. Beautiful. And that then is where you put in the extra piece of analysis. Now, Stan, before I go back to you, my last slide is my second step-by-step guide is, number one, I've already gone through this, is use the options analyzer for the data. That is a really super simple way that you can get the information that you need. And just in the way that I used it, you can get your price, you can change your strikes, you're looking at reliable data, it'll give you a graph. And I haven't touched on a lot of the functionality in Options Analyzer. But that is what I do, is that I use Options Analyzer to help me make the decisions that I need to make. Second thing I do is that I compare return and exposure. So I compare what is the return, what's the premium, divided by, and it's back on my Google Sheets there, my premium divided by the exposure. So what is the premium I'm taking in? And I divide that by the exposure. And of course, the exposure is the strike price. Then I look at what is that return, and specifically on an annualized basis. And then I make my decision. The next thing is I document why. I've told you that. I document why. Why am I thinking of taking position in this? Why did I get into Carnvial? Why did I get into Twitter? Why did I get into Hecla Mining? Why am I in Paychecks? Why am I in XLE? They're live positions that I have. If I want to get out, why am I getting out? And how does that compare to why I got in? Like I have said over and over again, is ask yourself if you would take delivery. Specifically when it comes to selling puts, ask yourself if you would take delivery. Because if you wouldn't, you're going to have to be, you need a different mindset. You do need a different mindset. You need a different mindset because you need to be out closing fast. Because that getting paid to wait to buy a stock that you want anyway doesn't apply. You're just trying to take in income, like Colin asked me. The last thing I'll say that I haven't said already is stagger the strikes. I stagger mine. I've shown you a glimpse of my portfolio there, where I have 2 options expiring now in August. I have ASM expiring in October. That was expiring in July, but I took it off the table. Twitter was expiring in July. I took it off the table. Carnvial was expiring in July, and I took that off the table. So, like, I would have a max of maybe three options positions around the same time. I don't concentrate the money just in case it was put to me early, and it has happened to me, is that stocks have been put to me early before expiry. I don't want to be letting that happen where, there's a strain on funds, or where I'm getting a call from my broker saying, okay, Susan, we're in margin call territory here. So I would also stagger strikes. So before I go back to Stan, thank you so much. Today what we did was I focused on the characteristics of selling options. I gave you 5 case studies from my own portfolio and how they wove in with the VectorVest system, which they all do. I document them in my views, and I have documented the views here in this so that Stan can share this with you. And then I've given my 2 step-by-step guides. So please, if you've liked the way in which my approach is, please do join me for Fantastic Female Fridays. Thank you, Stan, so much for giving that a shout out. This was the interview that I had yesterday with Linda, her first ever public appearance as CEO. So it was a pure delight. That is, of course, it's on YouTube. So that is where you can register for Fantastic Female Fridays. And otherwise, Stan, it's back to you.
Thank you so much, Susan. Wonderful comments coming in. Absolutely awesome, wonderful, great presentation, all of those good things. So that's pretty fantastic. Susan, a couple of questions before we close. So Stephen O, who's I know is a very experienced options trader. He just put out a public service announcement for everyone when selling or when looking for weekly options. There is a watch list in VectorVest under the special watch list. I wanted to pass that along. But his question was, when selling a cash security, but begin to sell calls against it.
No, I don't. Oh, wow. That is, if you're going to sell calls against it, that, like, if you sell a call, I find if you sell naked calls, that is a risky business. So no, I don't. I will happily, if I end up with the position, happily sell calls on it afterwards. I'll give you one stock that I did that actually on very successfully was Walmart. I remember I took on Walmart, like, when I look at the share price now, I think, oh, but of course, in options, sometimes you do well, sometimes you lose, and sometimes you lose out. But anyway, I sold a put on Walmart for $50. I ended up buying it, got lovely dividends in, sold a couple of calls. The stock was called off me, and that was that. So I only sell calls on a position that I have. I don't sell naked calls as a rule. I don't do it, Stan. No.
Okay, and everybody loved your spreadsheet. So
Great.
The question is, can they get it?
Yeah, of course. Gee Louise, of course you can. There's no point in here. No, I'm holding my
send it to me, I will send it out with the recording and the slides. And thank you for that. Related to the spreadsheet, though, we also had questions. I should look it up on the chat box, but I'll try to read my own writing here. Is there a particular percent on return in your formula that you find acceptable forward with a minimum percent that you're obviously the higher the better, but for a minimum?
I'll tell you why I'm breathing deeply and answering this question is the problem with that question is it's actually dependent on the time. Like the amount of volatility, Stan, as you know, that's out there now and was out there since February, primarily March, is so much bigger than this time last year. Like for me to be able to get a 6% return on selling an at the money option on the stock like Paychecks. If I tried to figure that out last year, I just couldn't have done it. So is there a minimum percentage? It kind of changes, and I know that's really frustrating to hear. But it does change. What I like to always try to do is that I can get an annualized return of at least 15%. And at the moment, I could get that by playing a game of tiddlywinks, because there is so much, as I say, volatility out there. I could get that so easily by selling an out of the money put in a stock with medium volatility. Like I could do that really easily. But by God, this time last year I couldn't have got that. I would have really struggled to get it, and I wasn't selling an awful lot of options because volatility was gone. So at the moment I wouldn't be taking anything less than 25% annualized a year. But if you invited me back on this forum in 6 months' time, I might have a different number for you. So I just want to be, I just want to tell the truth, and to be saying to people that it does change, and that's according to the fundamental volatility that's in the market. But right now, if it doesn't have 25%, you're off my list.
Awesome. Question 2 on the expiration date, selling for a minimum expiration. That might be a quick one, and I'll ask another one. A lot of people are saying they're already in the options paycheck course or taken it in the past. And the question that comes up often is also do spreads, which buy the put to protect sometimes, or do you like the cash covered put?
Yeah, I have, Stan. Yeah, I have. Now I'll tell you what I do though is it's spreads at the moment are always a good idea, always good idea. But when you're paying for volatility, it can, obviously then you have to shell out more of your return. For like I've had many spreads over the years. But here's what I do is that if I take a stock like Twitter, right, I am quite happy to own it. I'm quite happy to sell at the money puts, and if it's rising, I'm quite happy to sell and sell and sell and sell and sell and taking premium after premium after premium, without necessarily owning it. Well, what I might do then is I might buy a very long-term put, so that then I have basically, in essence, I suppose it's kind of like a calendar spread, but the intention isn't about arbitraging or trying to find a difference in time. My point is that I want to buy long-term insurance on a stock that I intend to hold on to for a long time. But on the other hand, I would also say, like, you can buy some really, really, really cheap puts that are well out of the money for very little. And I'll tell you one time, oh my God, this is the time that I had a role reversal. I sold a put on the Russian ETF when Crimea was annexed, because I said, right, look, it was the pits at the time, and I said nothing else could go wrong. Oh, I was so wrong. Instead, of course, the oil price plummeted because of a row that OPEC had. And actually, what happened was my long put. So I bought a put as well to protect the position. My long put rocketed in value because of all that was going on, and it was my saving grace. So I know I haven't spoken about that today, Stan, and perhaps I should have. But what I wanted to do today was to give some kind of wide-ranging examples of different scenarios when selling puts works, like in a high volatility but not a very rising market, like in the case of Paychecks. If you want to take on a stock or want to take a position but you want to diversify it a little bit, if you do take on a stock like Hecla Mining or take on an option, and then then it frustratingly rises and it doubles, and you think, oh God, I should have done differently. So I want to give a range of that and not overcomplicate it with the extra leg of the spread. But for sure, they're a great idea. And also, like, the options paycheck course is great. I mean, at the end of the day, we have an amazing guy who runs that. And so I'm not surprised that they're disciples of the spread methodology.
Awesome. Well, listen, I'll share with you one comment. Sylvie says, you inspire me to learn more about options. Thank you. Similar comments along the way. I thought Anne-Marie had a really great suggestion here as well. That is, we could modify Unisearch to have an RT delta greater than 1, for example, just to find those stocks that do have the rising volatility. RT is such a powerful indicator, and I think that's another great use of it as well. And then Jeff, I think Jeff's question was about the credit spread, so that's been answered. And I think Larry's question was answered. Um, and so Barry noticed in your, well, he says it was a fascinating presentation. So Barry from Halifax was just wondering, you use PE ratio on your graph, and I know VectorVest, Dr. Lito, PE isn't his favorite because it kind of have to put it in the context. But is it something that you rely on a lot, or why do you like it, along with some of the other indicators that you showed us? By the way, your searches are absolutely some of the best, and AI some of the best. But the PE
Mm-hmm.
ratio, just a question about that before.
Mm. Yeah, I suppose the PE ratio is something that I have looked at as a fundamental investor. Like, I am a fundamental investor at heart. I always look to technical analysis. I don't like, I just think, I think balance is so important. And I think the diversity of thought, but I look for fun as a longer term investor and an income focused investor. Fundamentally, I'm a fundamental investor at heart. So the PE ratio has always been one that's been that, that was taught to me from the very early stages. And I could never, I could never just stick with the idea of overpaying for earnings, because then earnings has to rise and not just meet those expectations, but rise and keep on rising, keep on rising. So I always thought the PE ratio was a good way to get, particularly to get defensive stocks and to get undervalued stocks. Now, I remember calling this totally wrong when Facebook was IPOing. I distinctly remember I was in Vienna at the time. We were holding a workshop in Vienna for VectorVest Europe, and like, the stock was $39. Of course, then it fell to 19. The PE ratio was 100, and then you look at its earnings last week and where it's at now, and also, of course, in terms of trends, like buying high and selling higher can work as well as buying low and selling high. But I just think, Stan, it gives me a way to take the temperature of the earnings and look at stocks that other people find uninteresting because they're not setting fire to their earnings charts. And there can be some interesting opportunities there. That's why. So it's because I'm fundamental. It's because that I don't like overpaying for earnings, because you can see some pretty interesting opportunities that look uninteresting to the naked eye.
It's another indicator, and it's in blocks.
Mm-hmm.
It's nice to use it, especially in other stocks in the same industry. Relevant. Excellent. Listen, Susan, there's questions, more wonderful comments. People did ask if they can get your webinar recordings. I want to let everyone know that you can go to the website in Canada, vectorvest.ca, and go down to the archive webinars. And what day?
So we do ours on Sunday, actually, Stan. So it is 3 p.m. Eastern time on a Sunday. That is when we run ours. Now, I will say that several of our weekly webinars are in Dutch, because we have a big base in the Netherlands and in Belgium. So any of you that don't understand, Dutch might have some challenges there. So I do around about one every 3 weeks, and then obviously I have Fantastic Female Fridays as well. So that and they're archived. They're all archived there. So tomorrow, Danny, one of our team in the Netherlands, or in Belgium, sorry, he will be running the webinar, and then it's back to me again.
So check in. I mean, you heard from Russell last time, Russell Markham of Australia, does the weekly webinar, and of course, Paul, his weekly webinar, so you can find them there. And of course, go Friday, Friday on topic, much more. Susan, I'm going to take back control so that I can just close off with a couple of slides and say thank you to.
And just while you're doing that, Stan, I just want to really thank you so much for giving me the opportunity, and also for for just giving me the chance to talk to your really loyal subscriber base here right around the world, but also for facilitating so expertly. It was great that I could focus on job at hand. You could feed the questions to me and I could answer them. So I'm just really, really grateful to you, and thank you for giving me the opportunity, and I appreciate all your preparation in advance of today.
Our pleasure. Thank you again. We'll have you back soon. You said 6 months would be a good time. So that'll be so shortly after the US election, and a lot of people are wondering how the markets will be affected after that. So that'll be a great time to have you back. I'm going to take control, show my screen, I hope.
Yep, back to you now.
Looks like that may have worked. Check here, sorry. Yeah, so I just wanted to let you know we do have a lot of new people watching, and if you like what you saw today from Susan's presentation, or some insights on the performance graph today and the market timing, give VectorVest a try for 30 days. It's $9.95 US, and it's risk-free from the point of view if you don't find it's making you money days, then all support. That's all. These are the contact numbers for you. That'll be in recording, which I'll try to get it out later today to many as I can, and some will get it tomorrow. And just want to thank you again for watching. Special thanks to Maze Colleton for a wonderful presentation. It's our support number. Get the maintenance later tonight at 11 o'clock. And if you comment, question for me, it's stan.heller, VectorVest. With that, thank you so much, everyone. Have a great rest of your day and next week. Thanks, everyone. Thank you all for your wonderful comments that are still coming in, and we appreciate it. Thanks to everyone who watched on YouTube as well. And the recording actually will be on YouTube probably shortly after we close.